What's your property investing endgame? This video is probably not going to be as exciting as the Avengers endgame, but we're going to be breaking down 3 different endgame strategies when it comes to property investment. There's been lots of property spookers and commentators and property gurus, lots of people chatting about property over the last 10, 15, 20 years with different endgame strategies. And I've broken this down into the 3 key endgame strategies that I believe people have used and can continue to use in different forms. No one strategy is right. There's no right or wrong here, but I thought it'd be great to explore and discuss my endgame, what I'm planning on doing, and these 3 different endgame strategies and how you might be able to apply one of them to your situation to take your property portfolio from a growth phase into a consolidation phase and see yourself into a retirement or a financial freedom phase. The first endgame strategy we're talking about is the equity harvester strategy. This almost feels like tied into negative gearing and that type of property portfolio. But in the early 2000s and the 2010s, equity harvesting was all the rage. Property commentators that I used to read and watch podcasts and read their books, like Michael Yardney and Conrad Bobliak, these guys were known for buying blue chip properties in blue chip locations, seeing massive amounts of growth and appreciation in that property portfolio, pulling out debt, buying more property and seeing growth again. What they did at the end of the day was then pull out some of that equity, live off some of the equity, save some of that equity to pay more interest, and then in 5 or 10 years' time, go again back to the bank and pull out equity down the track. Equity harvesting allowed these guys to do 2 different things. It allowed them to cash flow future purchases, and it also allowed them to create freedom and to create a lifestyle by design. Now, in my opinion, this strategy is not going to work as well as it has in the past. After we've had the Royal Banking Commission, APRA reviews, and crackdowns on lenders and lending restrictions, this type of environment where you go back to the bank, say my property's grown massively, and you try and influence the valuation to get the highest valuation possible and pull out more debt and just keep accumulating debt in your portfolio and living off some of that debt and then using some of that debt to buy more property doesn't work in today's environment as well as it used to do. It's certainly possible to equity harvest in today's lending environment, but you need to have massive day job incomes, you need to be able to service the debt, and you need to be able to handle those multiples, typically that 6 times debt to income ratio, to actually get access to more cash from the banks. You know, Steve McKnight's 250 properties in a couple of years is not really possible anymore, and so you need to be more strategic with your approach. Equity harvesting is a great way to grow your property portfolio, but I can't see it as the true endgame or the best endgame choice in today's environment. But it might be an option for some people who have the incomes and are okay with growing their debt over time, but for me, I don't want to have the debt continually increasing forever and using some of that debt to fund interest repayments and fund my lifestyle. Which I guess leads me into option number 2. Now we're talking about option number 2, which is the cash flow kings. This is guys like Nathan Birch, Eddie Deline, even the guys like Pumped on Property buying properties and adding granny flats or buying really cheap properties that cash flow really strongly. I really enjoy Nathan Birch's videos and how he goes out and buys a $100,000 property in the middle of nowhere and it cash flows ridiculously. But for me, there's also a fair bit of risk in buying those lower socioeconomic properties. You can have higher maintenance costs. You know, you imagine someone damages some walls or, you know, the roof, you have any issues with the roof or the flooring, then there can be thousands of dollars chewed away on a property that is at a lower price point. Now, the strategy for these guys is to accumulate a lot of properties at a lower price point, which cash flow really strongly and allow them to continue to service more debt and making sure that the cash flows are stronger than the repayments. The other option here, like the 2 properties to financial freedom, where you buy a couple of houses and build a couple of granny flats, is a great option in my opinion, who don't want to take on a large property portfolio, and it can be a great strategy. It depends whether it fits you as an investor. Going for a couple of houses and granny flats or going for a couple of cheaper properties scattered across major capital cities could be a great option for some people. So maybe being a cash flow king and sticking with those affordable properties is the right option for you. It's definitely a great way to scale and grow a property portfolio over time, and it gives you a fair bit of security because you know you can make your repayments back to the bank each month. What has been really interesting in the last few months is how some of the gurus and property commentators have seen almost negative cash flows in their portfolio as interest rates creep up and as interest rates rise. And if you've bought in areas that haven't grown, then you're not actually getting any net worth or creating much value in your property portfolio, and your cash flow could have been reduced because of the higher interest rates. So of course, there's risks with any strategy, but cash flow kings might suit people who are more risk averse, or people looking for options in those outer metro areas or major regional locations that cash flow well and might have some upside potential for growth. Now, option number 3 is the mixed approach, or the mixed lolly jar. So you start with capital growth first, and then you look to transition to cash flow properties over time to help you pay out and retire the debt and create passive income. The reason I start with growth is we can use those equity harvesting strategies, so strategy number 1, to grow and accumulate and build a property portfolio. Then over time, you can use the Cash King strategy, which is buy those cash flowing properties, boost your serviceability, and boost your passive income using the equity gains that you've had at the start of your property portfolio. So the mixed lolly jar, or the mixed approach, starts with capital growth first and then moves to cash flow and debt retirement towards its later phases. In my opinion, this is my end game. This is what I'm looking to do with Emily over the long term. We started with growth and now we're focusing on those cash flow properties. What we did, we bought 3 properties in blue chip areas in Brisbane's inner middle ring, and we added value to each of those deals to fast track our journey and to manufacture equity. We then equity harvested and looked to move to cash flow plays. That's why we bought the apartment block for around $1.4 million in Coffs Harbour, and we're again going to look to manufacture value at that property and do some development down there over time and some renovations. And now we're going to continue to look for those cash flow plays. Property is that long-term, slow game, so these property purchases, even though we've gone pretty fast, will continue to trickle over time. We're looking to grow the property portfolio to around that $10 million mark, and then we'll hold off on buying any more properties, and we'll look for the cash flow to slowly pay down the debt and increase our passive income over time. Now, whether you're an equity harvester, a cash flow king, or somewhere in between in that mixed approach, there's no right or wrong in this situation. I'm definitely not having a go at these historical commentators or these guys who do just equity and capital growth focused or cash flow focused. For me, it's about finding the balance and finding what works in your situation. I've definitely learned a whole lot from these commentators and these gurus, or however you want to describe them, YouTubers these days. And look, that's exactly what I'm trying to do here on this YouTube channel. I'm looking to provide free information to help those out there that are looking for help. If you're also interested in signing up to my course with that Do It With You method, I have Invest with Purpose, which is my real estate investing course, which gives you a step-by-step guide on how to buy investment properties, how to make your next investment purchase, and use that blueprint again to scale and grow a multi-million-dollar property portfolio. If you're looking to outsource and use a buyer's agent, maybe check out my website as well at purposeproperty.com.au, and we can have a chat, book in a free strategy session, and we can discuss how I might be able to help you buy and invest in the Brisbane market. I'd love to hear from you in the comments down below. What strategy are you going to use in growing your property portfolio? Are you an equity harvester? Are you a cash flow king? Or are you a mix of capital growth and cash flow? I replied to almost all the comments on my channel, so leave a comment down below. Let's have a conversation. Drop a like on this video, subscribe to the channel down below, and click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.